All right, let's dive into CoreWeave's latest earnings call from November 10th. This is a fascinating one because the AI infrastructure provider reported some truly spectacular growth, and yet the market decided to punish them for it. It's a classic Wall Street paradox, right? So, in this explainer, we're going to break down exactly what happened and, more importantly, what it could all mean for investors. So, this is the core mystery we need to unpack. On the surface, CoreWeave just hit a grand slam. I mean, they beat earnings, they raised their backlog, which is just their future order book, to a staggering new height. And what was their reward? The stock immediately dropped about 7% in after-hours trading. So what on earth did the market see that it didn't like? Let's get into it. Okay, first, let's just run through the good news, because believe me, there was a ton of it. Revenue for the third quarter? A record $1.365 billion. Now, to put that in perspective, this easily blew past what analysts were expecting, which was somewhere around $1.29 billion. So right off the bat, a really clean beat on the top line. And, it was pretty much the same story on the bottom line. The company's earnings per share came in about 30 cents better than what Wall Street was forecasting. So you've got a beat on revenue and a beat on earnings. Everything's looking great, right? So far, so good. But then we get to the really big one, $55.6 billion. And just to be clear, that's their revenue backlog. It's the total value of all the contracts they've already signed for future work. And get this, it nearly doubled in one quarter. I mean, that is signaling an absolute tsunami of demand for their AI infrastructure. In any normal world, a number like that, wow, that would be cause for a massive party. So yeah, that massive backlog didn't just appear out of thin air. It was really fueled by what you can only call a record-breaking quarter of just pure operational execution. I mean, just look at what they pulled off. They locked in these huge, expanded deals with the biggest names in the game. We're talking Meta and OpenAI. They also became the first cloud provider in the world to get their hands on and deploy NVIDIA's brand new GB300 systems. That is a massive technical win. And maybe most importantly, they seriously diversified their customer base. Think about this. At the start of the year, one single customer made up 85% of their backlog. That is risky. But now, that number is down to just 35%. That's a way healthier, much more resilient business model. Okay, so we've got stellar results, a booming order book. Everything looks fantastic. So you have to ask yourself, where is the disconnect? Well, the answer isn't in what they did this past quarter. It's all about what they said they were going to do next. So where did it all go wrong? Well, it boils down to one word: guidance. You see, even with that absolutely colossal long-term demand signal from the backlog, the company's short-term forecast, for the road immediately ahead, well, it hit a pretty major speed bump. So here's the problem in a nutshell. The market, Wall Street, they were all expecting a big raise to the full-year outlook. But instead, management came out and delivered what they called a guidance reset. They guided their full-year revenue to a range right around $5.1 billion. Now look, that is still huge, massive growth, but it just fell short of the market's sky-high expectations. And it was that downward revision that really spooked investors. Now, management on the earnings call, they were very, very clear about one thing. They said this is not a demand problem, this is a timing problem. And that is a really important distinction, one that the market, at least at first, seemed to completely ignore. So what was the cause? The entire guidance cut was blamed on just one thing: a delay from a single third-party data center developer. It's actually that simple. One of the companies that's responsible for building the physical house for all of CoreWeave's servers, well, they just fell behind schedule. And the specific bottleneck here is something called a powered shell. The best way to think about it is like an empty house right before you move the furniture in. The building is up, the power is hooked up, the fiber optic cables are there, but the really expensive stuff, the GPUs and the servers, they haven't been installed yet. So this isn't a problem with getting NVIDIA chips or a lack of electricity. This is literally just a delay in the physical construction of one single site. So this whole situation basically set up two completely different stories. You've got management's view, and then you have the market's reaction. Management was adamant, hey, this is just a temporary, isolated hiccup. They stressed that the customer involved just extended their contract, so no revenue is actually lost, it's just pushed out a little bit. But the market heard a different story. They saw this as a sign of execution risk. For traders, a delay is a delay, period. And that uncertainty was more than enough to trigger that big sell-off.
And all of this brings us to the big question for anyone looking at this stock. What happens on the next call? Is this really just a one-time issue like management says, or is this the start of a worrying trend?
All right, so what's our call here? From our perspective, the thesis is pretty clear. Buy this execution dip. We are rating the stock outperform. And the rationale is simple. The real story here isn't the temporary delay. The real story is that $55.6 billion backlog. That gives you multi-year visibility that in our view far outweighs one short-term construction hiccup. Sure, the risk is all about near-term timing, but the catalyst will be the moment they prove the build-outs are back on track. That's when the market is going to wake up and remember that giant order book. Look, at the end of the day, the play here isn't about trying to perfectly guess next quarter's exact revenue number. It's about looking past what seems to be a temporary air pocket. It's about buying this execution dip before the rest of the market wakes up and fully reprices that massive multi-year backlog. It really boils down to this. The market sold off on the delay. The real opportunity is buying the long-term demand.
And of course, a reminder that this is not financial advice. You should always do your own research before making any investment decisions.